The federal government can raise money from financial markets to finance its deficits by issuing bonds. In general, a corporate bond's coupon rate is fixed until the bond matures. While the bond's value fluctuated over time, the coupon rate and par value are fixed while market interest rate change. There is, in parentheses, negative relationship between market interest and bond value. Which of the following variables are required to calculate the value of the bonds? Coupon rate, remaining life of bond, market yield. When a corporation or government wishes to borrow money from the public on a long-term basis, it usually does so by issuing a selling debt security that are generally called bonds. What is the corporate bond yield to maturity? Yield to maturity is the expected return of the investor who buys the bond today and holds it to maturity, or yield to maturity is the prevailing market interest rate of the bonds with similar features. Bonds pay annual interest payment of $50 has a par value of $10,000 and market price of $1,200. How is the coupon rate computed? So annual interest payment $50 divided by $1,000 par payment. Recent bond is annual interest payment divided by par value. If $1,000 par value bond is trading at a discounted rate, it means that the market value of bond is less than 1,000. Bond value is not affected by changes in the market rate of interest. No, it is affected by the changes of market interest rate. What is a premium bond? Premium bond is a bond that sells for more than face value. The relationship between bond prices and the market rate of interest is inverse. If the market rate of interest rise, bond price will fall, vice versa. Which of those are required to calculate current value of a bond? Current value of a bond is the applicable market rate, par value, coupon rate, time remaining to maturity. A corporate bond's yield to maturity can be greater than, equal to, or less than the bond coupon rate changes over time. What is a discounted bond? Discounted bonds are the bonds that sell for less than the face value. $1,000 par value bond is trading at a premium. The bond is trading for more than $1,000 in the market. As an investor in the bond market, why should you be concerned about changes in interest rates? Changes in interest rates cause changes in bond price. When interest rates in the market fall, bond value are likely increased because the present value of the bond remaining cash flow increased. Which of the following is true about interest rate risk? All else equal, the lower the coupon rate, the greater the interest rate risk. All else equal, the longer the time to maturity, the greater the interest rate risk. Which of the following variables are required to calculate the value of bonds? Coupon rate, remaining life of bond, market yield. What is a corporate bond yield to maturity? Yield to maturity is the prevailing market increase rate of the bond with similar features. Or yield to maturity is the expected return for an investor who buys the bond today and holds it to maturity. The reason that investor risk the reason that interest rate risk is greater for a long-term bond than for short-term bond is that the changes in rate has a greater effect on present value of the face value than on the present value of the coupon payments. Long-term short face value coupon payments. Okay. If $1,000 par value is trading at a discount, mean that the market value of the bond is less than $1,000. The current yield is that the bond annual coupon divided by its price. The current yield is the annual coupon divided by its price. Which one of the following is the most important source of risk from owning bonds? Market interest rate fluctuations. Equity represents an ownership interest. It's true. The degree of interest rate risk depends on the sensitivity of the bond's price to interest changes. Which of those are required to calculate the current value of a bond? Time remaining to maturity, applicable market rate, par value, coupon rate. The main reason it is important to distinguish between debt and equity is that the benefit and risk are different. So between debt and equity is the benefit and risk are different. Long-term bonds have greater interest rate sensitivity because a larger portion of a bond value comes from the face amount. What are the two major forms of long-term debt? What are the two major forms of long-term debt? Public issue and privately placed. What are the two major forms of long-term debt? One is the public issue. Second is privately placed. What is a bond current yield? What is a bond's current yield? Current yield is annual coupon payment divided by current price. Current yield is the annual coupon payment divided by current price. Which of the following is not different between debt and equity? Which of the following is not different between debt and equity? Equity is publicly traded, which debt is not. Which of the following is not a difference between debt and equity? Equity is a publicly traded, which debt, while debt is not. A debenture, so debenture, debenture, is an unsecured bond for which no specific pledge of property is made. Which of the following is true about interest rate risk? Interest rate risk, all else equal, the lower coupon rate, the greater the interest rate risk. All else is equal, the longer the time to mature, the greater the interest rate risk. Which of those risks is addressed by bond ratings? So default risk. So default risk, it's addressed by bond ratings. As a general rule, which of the following are true of debt and equity? Equity represents an ownership interest. The maximum reward for owning debt is fixed. As a general rule, which of the following are true of debt and equity? Equity represents an ownership interest. The maximum reward for owning debt is fixed. In terms of time to maturity, U.S. Treasury notes and bonds have initial maturity range from 2 to 30 years. The two major forms of long-term debt are public issue and privately placed. Which of the following correctly identify this difference between U.S. Treasury bonds and corporate bonds? The Treasury bonds are issued by U.S. government while corporate bonds are issued by corporations. Treasury bonds are considered free of default risk, while corporate bonds are exposed to default risk. Treasury bonds offer certain tax benefits to investors that corporate bonds cannot offer. The current yield is the bond annual coupon. The current yield is the bond's annual coupon divided by its price. What are the cash flow involved in purchase of a 5-year zero coupon bond that has a par value of 1,000 if the current price is 800? Assume the market rate interest rate is 5%. So pay today $800, receive $1,000 at the end of 5 years. Place the following bonds in order of security as defined in the United States: mortgage bonds and then debenture bonds. So the order of security of the bond is start with the mortgage bond first and then debenture bonds. With a floating rate bonds, the coupon payments are adjustable. So floating rate bond, it means the coupon payments are adjustable. What does a bond rating reflect? The ability of the firm to repay its debts and interest on time. U.S. government borrow money by issuing treasury notes, treasury bills, treasury bonds. How is investing in U.S. Treasury bonds different from investing the coupon? How is investing in U.S. Treasury bond different from investing in corporate bonds? Interest from U.S. Treasury is exempt from the tax at the state level, but corporate interest is not. Treasury issues have no default risk. A zero coupon bond is a bond that makes no interest payment. Most of the time, floating rate bond coupon adjust with a lag to some base rate. Most of the time, a floating rate bond coupon adjusts with a lag to some base rate. The U.S. Treasury market is the largest in the world in terms of trading value. A limitation of bond rating is that they focus exclusively on default risk. What are some reasons why the bond market is so big? Many corporations have multiple bonds issued outstanding. Federal government borrowing actively in the bond market is enormous. Various state and local governments also participate in the bond market. In terms of time to maturity, U.S. Treasury notes and bonds have initial maturity ranging from 2 to 30 years. What is a real rate of a return? What is a real rate of return? It is a rate of return that has been adjusted in inflation. Which of those correctly identify difference between U.S. Treasury bonds and corporate bonds? Treasury bonds are issued by the U.S. government while corporate bonds are issued by corporations. Treasury bonds are considered free of default risk, while corporate bonds are exposed to default risk. Treasury bonds offer certain tax benefits to investors that corporate bonds cannot offer. What are the cash flow involved in the purchase of a 5-year zero coupon that has a par value of 1,000? If the current price is 800, assume the market rate of interest is 5%. Pay $800 today and receive 1,000 at the end of 5 years. Features effect decomposes the nominal rate into the inflation rate and the real rate. Which is the largest security market in the world in terms of trading value? The U.S. Treasury market. What are some reasons why the bond market is so big? Various state and local governments also participate in the bond market. Federal government borrowing activity in the bond market is enormous. Many corporations have multiple bond issues outstanding. The real rate of return will generally be higher than the nominal rate of return. No. Generally, nominal rate of return is higher than real rate return. How is investing in U.S. Treasury bond different from investing from corporation bonds? Interest from U.S. Treasuries is exempt from taxes at the state level, but corporate interest rate is not. Treasury issues have no default risk. If a given set of cash flow is expressed in nominal terms and discounted at the nominal rate, the resulting represent value will be the same as if each cash flow were expressed in a real term and discounted at the real rate. Which one of those correctly specifies the relationship between nominal rate and the real rate? So 1 plus R equal 1 plus R times 1 plus H. So the nominal rate is relationship nominal rate and the real rate is 1 plus R equal 1 plus R times 1 plus H. What does historical data suggest about the nature of short-term and long-term interest risk? Sometimes short-term rates are higher and sometimes long-term rates are higher. The US Treasury market is the largest in the world in terms of trading volume. The inflation premium will be higher if the rate of inflation is low. Fault. What are some reasons why the bond market is so big? Federal government borrowing activity in the bond market is enormous. Various state and local government also participate in bonds market. Many corporations have multiple bonds issues outstanding. Interest earned on treasury notes and bond are taxable. True. What is real rate of return? What is the real rate of return? It is a rate of return that has been adjusted from inflation. Which of the following is not one of the 6 factors used to determine the yield on a bond? Voting rights. What is the 6 factors used to determine the yield on bond? Real rate of the return, expected future inflation, liquidity, interest rate risk, taxability, default risk. If a given set of cash flow is expressed in nominal term and discounted at the nominal rate, the resulting present value will be the same as if the cash flow were expressed in real term and discounted at the real rate. The term structure of interest rates examines the relationship between short-term and long-term interest rate. So the inflation premium is the portion of a nominal interest rate that represents compensation of expected future inflation. What are the 3 important features of treasury notes and bonds? Taxable, highly liquid, default-free. Which 6 factors determine the yields on a bond? Expected future inflation, liquidity, interest rate risk, real rate of return, default risk, taxability. If a given set of cash flow is expressed in nominal term and discounted at nominal rate, the resulting represent value will be the same as if the cash flow were expressed in real term and discounted at the real rate. The feature effect has all of the following coupon components except expected rate of return, E. Feature effect has all of the following components except expected rate of return, E. When comparing a 10-year bond versus a 1-year bond, the 10-year bond has a much greater interest rate risk. It's true. Interest rate risk is the risk that arises for bond owners from fluctuating interest rate, all other things being equal. So the longer the time to maturity, the greater the interest rate risk. So let's look at the other version. Interest rate risk is the risk that arises for bond owner from the fluctuating interest rate. All other things being equal, the lower coupon rate, the greater interest risk is. Municipal bonds are taxable for federal, state, and local taxes. Fault. Municipal bonds are not taxable at federal, state, and local taxes. So, Frank, after tax, the term structure of interest rate tell us what nominal interest rate are on default-free pure discount bonds of all maturities. So the term structure of interest rate tells us what nominal interest rate are on default-free pure discount bonds of all maturities. When short-term rates are higher than long-term rate, we say it is downward sloping. The term structure of interest rate includes all of the following basis components except weighted average cost of capital. The term structure of interest rate includes real rate of interest, rate of inflation, interest rate risk. Treasury issues are exempt from state income tax but not federal income tax. The features of municipal bonds make them attractive to higher income, higher tax bracket investors. So match the type of bond in the definition by its definitions. Catastrophe bond is a it covers hurricanes and earthquake in U.S. A warrant bond is give to buyer of a bond the right to purchase shares of stock in the company at the fixed price. So catastrophe bond is covers hurricanes and earthquakes in U.S. A warranty bond gives the buyer of a bond the right to purchase shares of stock in the company at the fixed price. So, an income bond is a states that the bond coupon payment. An income bond states that bond's coupon payment depends on company income. A convertible bond can be swapped for a fixed amount of shares of stock anytime before maturity at the holder's option. A put bond. So a put bond allows the holder to force the issuer to buy back the bond at the state price. Warrant. Current yield is the bond's annual coupon divided by its yield to maturity. Fault. Recently, you discover a convertible callable bond with semi-annual coupon rate of 5%. If you purchase this bond, you will have the right to convert the bond into equity shares. So the bond has a face value of $1,000. It can be redeemed early at the issuer discretion for $1,015 plus any accrued interest. Additional $15 is called premium. A call protected bond is a bond that cannot be called during the given period of time. Which one of the following applies to the premium bond? Premium bond have the highest coupon rate, and then current yield, and then yield to maturity. A fallen angel is a bond that has moved from investment grade to speculative grade. The taxability risk premium compensates bondholders for which one of the following: a bond's unfavorable tax status,